So good morning once again. The day is off to another terrific start, and I want to welcome you back after the break to our second panel of the day, Global Financial Stability, How Does China Measure Up? It gives me great pleasure to introduce, to begin this panel, my esteemed colleague, Robert Engle, who will lead the discussion on global financial stability. Rob won the 2003 Nobel Prize in Economics for his groundbreaking research in volatility. Under Rob's leadership of Stern's Volatility Institute, the school remains at the forefront of research on global systemic risk. And let me just add on a personal note that in addition to clearly being one of the world's leading economists, Rob is one of Stern's truly distinguished individuals, is just a gentleman and a pleasure to work with. He's the kind of person who, when you're in Rob's company, not only do you feel a little smarter because he's so smart, but you just feel like a better person because he's such a gentleman to be with. And getting back to the agenda at hand, aside from Rob's personal characteristics, the volatility of credit risk, as we know, played a key role in the financial crisis of 2008, prompted post-crisis financial regulation in the US and Europe, and continues to influence the financial markets in real economies around the world. Rob and his colleagues created the NYU Stern Global Systemic Risk Rankings to examine the global risks to the real economy from the financial system. And these risk rankings provide an estimate of the capital that a financial institution would have to raise in order to function normally in the event of a future crisis. He calculates this measure for roughly 1,200 global institutions and follows trends in regions, countries, and firms. And so the question at hand is, how does China measure up? And we have probably the best person in the world to answer this question for us this morning. Ladies and gentlemen, please welcome Rob Engle.
Well, thank you, Dean Henry, and thank all of you for coming today. It's such an exciting enterprise we're doing here, looking at the development of NYU in Shanghai and all the kinds of collaboration and cooperation we can do between New York and China. It's very exciting. So I'd like to talk to you today about some of the things we've found when we've been looking at systemic risk measures around the world, and in particular when we put them into the Chinese context, what do we really see? So I'm going to talk about global financial stability from the point of view of China. So just as we all have observed, the financial crisis made it very clear that a failure of the financial system could have dramatic effects on the real economy. We saw the global economy collapse in 2007 to 2009. We've also seen more recently in Europe, the sovereign debt crisis has paralyzed Europe, which is now in a recession. At least most of the countries, I think, are growing in a negative direction. And it's a second type of financial failure, but it seems to be perhaps slightly different, but seems to have the same effect. So the question that naturally comes up, can we foresee and prevent these kinds of events? Well, of course, this is the concern, isn't it? Are we closing the gate after? Too late. Well, let's see what we can see. One of the dramatic features of the financial crisis was the Lehman failure, which presaged the worst part of the financial crisis for the US and for the rest of the world. But we sometimes forget that this happened almost exactly at the same time as Fannie and Freddie had to be nationalized. Their giant mortgage companies had to be nationalized in the US. Citibank had to be rescued. Bank of America had to be rescued. Merrill Lynch was bought. Goldman Sachs and Morgan Stanley had to be rescued. AIG had to be rescued. WAMU failed. Wachovia was bought. And there were many more firms in perilous financial conditions. So this is not really a story about Lehman. Lehman is sometimes been thought of as a domino. You know dominoes, this little game that children play. When one falls over, it knocks over the next one, and there's a whole chain. But one of the things about the domino theory is it doesn't matter which one gets knocked over first. Each one sort of affects the whole chain. I don't think that's what we're talking about here. We're talking about a tsunami. And I suppose you know the word tsunami. It's a tidal wave, and this overwhelmed the whole financial sector. It's not just one bank. It was the financial sector that was weak. They had all invested in the same products. They were all weakened by the failure of the mortgage-backed securities that they bought, and they all failed together. So we want to build measures of risk that take this into account. So what do we see if we look at China from this point of view? Well, China is the second largest economy in the world, one of the largest foreign exchange reserves, an amazing record of growth, a stable and forward-looking political system, and a carefully managed economy. So could China have a risk like what we saw? Well, that's what we want to talk about today. It's got a banking system which is really not as effective as the rest of the economy. It's got slow-moving state enterprises, which may not be the source of as much innovation and economic growth as we'd like. And these put together, we think, can pose a risk. So we want to look at some measures. So Peter mentioned the question that I'd like to ask over and over and over again today, which is, how much capital would a financial firm need to raise in order to be able to function normally if we have another financial crisis? It's a question of how much of a cushion do financial firms really have? Do they have enough cushion to survive a financial crisis? Because clearly, if a firm has enough of a cushion to survive a financial crisis, there can't be a financial crisis. You've prevented the financial crisis if the capital cushion is sufficient. And this is exactly what regulators are trying to do. They're trying to figure out how to regulate banks so that they have sufficient financial capital to weather a storm like this. So this number is a number of dollars. We are going to estimate it for more than 1,000 financial firms around the world. We are going to update it weekly and publish it on our website called VLab, which you can see from your hotel room. You can see it anywhere. And this number is called S-risk, for systemic risk. So how does it work? What really is being measured? I'm going to tell you how it's being measured by example. Bank of America has a market cap, that is the total value of its stock, is $141 billion. Its accounting liabilities, this is basically its debt, what it owes, there are $2 trillion. So it has what we call the leverage ratio of 14.9. We think that's slightly higher than what would be a normal, healthy basis, but pretty much in the right ballpark. If we have another financial crisis, by which we think of the global equity market collapsing by 40% over the next 6 months, what is that going to do to the market cap of Bank of America? This is what we call the beta in finance, and we have a modern way of estimating the beta, which continually evolves over time, and we argue that the beta of Bank of America is about 1 today, but actually if the market declines, the beta will rise a little bit, and so it will be a 50% decline in the market cap of Bank of America stock. Consequently, the leverage will increase, and it will be short capital from this desired leverage ratio we have in mind, and they would have to raise capital, and we think the number that what they would need would be 91 billion in order to bring their leverage down to a reasonable level in the event of a crisis. So that's a pretty simple kind of model. It's what we're going to estimate over and over again, but let me give you just a second example quickly, which is Crédit Agricole. This is a French bank. It's actually the bank that I use when I'm in France. It has a market cap of 23 billion and liabilities of 2.2 trillion. It has a leverage ratio, therefore, of 102 already. It is incredibly leveraged. Any movement in underlying asset values will have a dramatic effect on the capital available to Crédit Agricole, and it presumably is an extremely risky institution, although the chances are good that the French government will not let it fail. Also, most likely, Crédit Agricole knows this and is carefully trying to rebuild its capital base by not making any loans, or certainly not any loans with any risk. So we think that this measure of S risk is a measure of systemic risk for exactly the sort of reasons you're seeing here. Any bank that has a high S risk is going to try to reduce it, either because regulators tell them to or because they just think it's the smart thing to do. And they'll do this by selling assets and making fewer loans. As you can see, if the entire sector has a high S risk, this is going to starve the real economy from capital. The real economy will decline. The stock market will go down. As the stock market goes down, S risk goes up even further. So we have a spiral that happens here. It leads to higher and higher S risk, lower and lower GDP and the real economy. Ultimately, these banks are likely to go bankrupt. We are likely to see a collapse of the financial sector, and it will only recover when the profits of going into banking look like they're high enough to offset these risks. And so new capital will come into the industry. But it can be stopped before the bottom by putting public money in. If taxpayers put money into the banks to recapitalize them, it can stop this spiral, and it's really what happened during the financial crisis. It's what Europe is trying to figure out whether they want to do or not, and it's part of the public policy that has to do with these kinds of banking cycles. Of course, we recognize that if there is public capital rescuing banks on the downside, then that takes away their incentive to reduce risk. And so the moral hazard problem that economists talk about is implicitly or explicitly in this, on this slide. So the idea is that we really need regulation in advance to keep this from being a situation that comes up. That is, regulators should, in good times, regulate institutions so that they have adequate capital so they can survive a future financial crisis. This is not the way we really want to run our financial system. So you might wonder why an institution would ever have positive S risk if they listen to this talk. And I think there are several answers to this. One is that, as I said, one institution can have a high S risk without it being a risk to the economy. So is it Lehman, or is it some other institution that decides they will be the leader in taking excessive risk because it's not a risk to the economy? But of course, who goes first, who goes second pretty soon we have a dangerous situation. Second of all, of course, we may have implicit or explicit government guarantees, such as too big to fail or deposit insurance, which will encourage all institutions to take positive S risk. Or thirdly, we may have regulatory incentives that we don't fully recognize that encourage investments that might not otherwise be prudent. In other words, the regulators themselves may do things to make S risk go up. And of course, we may have miscalculation. I think that was a big part of this during the financial crisis. So I'm an econometrician, so I could tell you, I could bore you for a long time with the econometrics of risk, but I'm not going to do that. What I'm going to tell you is simply that we use our estimates of volatilities that are changing over time, correlations that are changing over time, and tail risk, which is implicitly always with us, to estimate these dynamic conditional betas that are needed to calculate the impact or the risk, basically, of each institutions. We use things like Glosson, GJR, GARCH, DCC, and dynamic conditional beta and copulas to do this estimation, and that's all I'm going to tell you. And so this is the website, and I'm going to show you now some results. So this is the sum of S risk for the entire globe. And it's measured in dollars on the right-hand axis. And as you can see, it was high during the financial crisis in the fall of 2008. It was up to about $4 trillion. It's what it looked like that would be needed to rescue the financial sector. It came down very nicely after that, but then it shot up again to about the same level in the summer of 2011 as the European sovereign debt crisis coincided with our deficit ceiling debacle in the US and raised total S risk back up to the $4 trillion mark. In the last year, it has been coming down, as you can see, and so now we think that the total is somewhere a little around maybe 3.2 trillion. This is kind of like the reserves in China, right? So just to give you an idea what we're talking about. How is this decomposed by country? Well, it turns out that the country with the highest S risk by our measure is Japan. Second is the United States, and third is China. Then we have France, UK, Germany, Italy, Canada, Spain, Switzerland, Netherlands, India, and so forth, on down to, this is the top 20, but we have about, I think, maybe 40, 50 countries in this database. But of course, not all countries are the equal size. This is measured in dollars. Maybe we should measure it relative to GDP, because that tells us how much resources we have to try to offset this systemic risk. And if we do the same table relative to GDP, you can see number one is Cyprus. Cyprus, it would take 22% of its GDP to rescue its banks. That is impossible for any country to do, and it's one of the reasons why Cyprus can't solve its own problems. Cyprus needs external help, or it needs to get out of the Eurozone so it can devalue itself enough to pass these costs on. Second is Switzerland, which is a big financial center, obviously, and has taken a rather different strategy. They are going to require excessively high capital cushions for their banks because they don't want to be in the situation that Cyprus is in, where they have to put in a big chunk of GDP. Then France is third, and that's on my watch list. What's going to happen in France? UK, Netherlands, Greece. UK was in the paper today. The regulator in UK argued that the banks were undercapitalized. They listed the same ones that we have at the top of the list, but their list was from December. So we do it every week. Going down the list, we find China is 4 from the bottom, but actually below it are both Ireland and Portugal, which are cases we will mention later. So within this global picture, we have 3 rather different paths of S-risk. The top is the US, and what you see is the US has never gotten as high as it was during the financial crisis, and in fact is today substantially less than it was during the financial crisis. It's less than 400 billion now, and if you remember, the TARP program that we used to rescue the banks was 700 billion. So this is now substantially better. It's not zero, but it's much better than it was. In the middle is Europe, and you can see that Europe has not had the big decline that the US has had. It had a nice decline between 2009 and 2010, but then it has gone back up again, and there is some evidence that it's declining at the end of this, but I am not convinced that the European sovereign debt crisis is over. The third picture is Asia. So Europe today, the number is about 1.5 trillion, and in Asia, the last value on here is 1.2 trillion. So if Europe's in trouble, Asia is in trouble. It's the same kind of number. But what's more worrying about Asia is how this graph is increasing. You can see that the financial crisis was not a big event in most of Asia on the left-hand side of this graph, but there's been a substantial increase and really not much moderation in the rate of increase as you get to the right-hand side of this graph. The 2 biggest economies in Asia are, of course, Japan, and you can see this dramatic increase in Japan S-risk. This is really a result, I think, of the Japanese government bonds that are in the banks in Japan, which the stock market thinks are not worth their face value, and consequently, these banks have liabilities which are considerably bigger than the market thinks the value of the firm is, so that their leverage has been increasing. There is a little bit of evidence at the end that Abe economics is working as there is some moderation on the far right-hand side. And here's China. As you can see, China had almost no risk during the financial crisis. It was practically zero until maybe January of 2011. But since then, it's been rising dramatically. There has been a very substantial increase in the amount of money that would be needed to rescue Chinese banking system if we have another financial crisis. The number on the far right number is $350 billion. This is not a big number compared to the reserves of China, compared to the size of China, but the growth in this picture is quite worrying. Here's a little bit of a detailed slide that you probably can't see, but this looks at all the Asian firms ranked by their S-risk. And the top 3 are Japanese: Mitsubishi, Mizuho, and Sumitomo. The next 4 are the big Chinese banks: China Construction Bank, Agricultural Bank, Industrial and Commercial Bank, and Bank of China. I can't read my own slides. You probably can't either. But in any case, the big 4 Chinese banks are next on this list. And the S-risk goes from 140 billion for Mitsubishi down to 30 billion for the Bank of Communications. Or actually, I guess the Industrial and Commercial Bank is 32. So in any case, there's a big variation in those. But let's take a quick look at what you can also see, which is how these have changed. If you look at the changes in these numbers, and in fact on the website you can see there are 2 little date boxes on the top. On the left-hand one you can you can set what you mean by today. And on the right-hand one, you can set a date at which you want to see the change from. So I'm looking at the change from a year ago till today. And what you see is that the top 3 banks, which are the Japanese banks, have all had substantial reductions in their risk over the last year. That's the good news for the Abe economics. It basically is a reduction in their debt and a reduction in the risk component due to equity. So that means that stock prices have gone up for these banks as well. On the other hand, their risk has increased, and that's increased the S-risk. The next 4 banks are the big 4 Chinese banks, and you can see that they have all increased their S-risk over the last year. This has been primarily through an increase in debt, increase in liabilities. The banks have increased their liabilities while the Japanese banks have been decreasing their liabilities. Their equity has also gone up so that this reduces the S-risk, and the risk has not changed in a systematic way. If you look over 5 years, you can do the same thing, and what you see is that all 7 of these banks have had substantial increases in their debt. Their equity has fallen, meaning that that's contributed to the S-risk, and some of them have had big changes in their risk appetite. So this is a way we can try to see what is happening. What are the causes? Now, one of the topics of conversation is what's really going on in these Chinese banks that makes it look like this. And obviously, I'm not the world's best person to do this, so I'm using information from other people, but there is some evidence that there are issues with the Chinese municipal debt and with debt to state-owned enterprises. These are perhaps burdens on the Chinese banking system. And for example, in 2008, it looked like local government debt was 1.7 trillion yuan, whereas at the end of 2010, it was 10.7 trillion yuan, or 27% of GDP. That's a staggering increase in local government debt. Much of this was the stimulus package that was put into place to counteract the global recession. But local governments can't borrow directly from the state-owned enterprise, from the banks, so they established, apparently, 6,000 different special financing vehicles to do this. And this is really the shadow banking sector, or part of the shadow banking sector that we talk about. And of this debt, 8.5 trillion yuan is apparently due or needs to be rolled over over the last 2 years. Will these loans perform? Local governments have inadequate sources of income because they don't have either borrowing or taxing authority. And so a lot of these loans are collateralized by real estate. So that makes this a kind of a risky proposition, and there is a view that much of this will not be performing loans. And the Wall Street Journal recently reported that all municipal loans were rolled over at the end of 2012 and may have to be rolled over again and again. Furthermore, bank lending to state-owned enterprises also grew very rapidly in this period, presumably because these were more secure and less likely to default than loans to the private sector in China. But growth of the SOEs at the expense of the private firm is likely to be a negative for economic growth in China, and China is likely to be looking for sources of economic growth, and the state-owned enterprises may not really be the best answer. There's also reports that many of these loans were used to speculate in real estate by the state-owned enterprises, and so this is, again, not productive lending. It's lending that will contribute to a property bubble if there is one, and will likely underperform if the property market doesn't continue to increase. So what are the implications? Well, the implications are that the banks have potentially a lot of non-performing loans. Now, this is actually the same thing that happened in Europe, and it's the same thing that happened in Japan. In Japan, it was government bonds. In Europe, it was sovereign bonds from Greece and Portugal and Spain and so forth. And what happens is the stock market discounts the valuation of these banks. And consequently, they have a low valuation relative to their liabilities. And that shows up as a high S risk for us. Is that what's happening in China? Well, it turns out that the banks are getting a low valuation in China, but I suspect not as low as really would be economically what we would have in mind, because there is an implicit guarantee. In fact, these are state-owned banks, so that they are surely going to be rescued. The loans they make to local governments and to SOEs are almost surely not going to default and fail. They're going to be rolled over, so that the risks that a stockholder takes by investing in these banks are not as great as you might expect given the economic circumstances of these banks. So I think this means that the S risk measure that we have is probably an understatement of the true risks of the banking sector in China. So let me just show you the slide that I showed you before, which is, why would any institution have positive S risk? One answer is implicit and explicit government guarantees, such as deposit insurance or too big to fail assurances. So just exactly the fact that the banks will surely be rescued is the same reason why they have little incentive to reduce their risks and to improve their balance sheets. This is the problem of how do you regulate a state-owned enterprise such as the banking sector. Second of all, regulatory incentives that encourage investments that might not be prudent. Well, we have lots of reason to believe that there are directives telling these banks who they should lend to, who they should not lend to, and these directives may or may not be associated with the true risk and return of these banking sectors. So the banking sector in China really does not have a good way of evaluating the quality of loans. It's distorted by these various incentives. And of course, miscalculation could be true here as well. So can China afford to recapitalize its banks? Well, unlike Portugal, Ireland, Greece, Spain, Switzerland, and France, China has vast reserves. However, in a slowing economy, we could see lots of demands on these reserves. This is not the only sector that is on China's agenda for reform, and it might be that these reserves are not going to be, we're not going to be the only claimant on these reserves. Furthermore, the foreign exchange reserves, which are so gigantic and dramatic, are actually not that accessible. If China decides to use its foreign exchange reserves, that's going to make it much more difficult for them to continue their exchange rate policy, and is likely to lead to a depreciation of the dollar relative to the renminbi, or the appreciation of the renminbi, which is really a policy that China is not anxious to do. So my feeling is that today China has the reserves to recapitalize its banks if it needs to. It doesn't have to think about whether to do this. It will do it. We can see this, I think, in this current policy regime that we've seen over the last week or two, some tightening of the bank reserves in China, but also apparently some liquidity provision to struggling members. So I think this is not a risk in the short run. but the trajectory is very worrying, and I think it's really one of the important agenda items, should be one of the important agenda items, and I think it is one of the important agenda items for the new administration in China. And for all of us, the main thing is we can keep watching it on VLab and see how it's doing. So, oh, is that what we're going to see? Or is that the answer? Anyway, thank you.
Thank you so much, Professor Engle. Let me invite my panelists. I'm Vijay Vaidiswaran. I'm the China business editor for The Economist, and it's my great honor to be here with you today to moderate this panel. Let me invite the rest of our panelists on stage, please, and I'll introduce them after they come and sit down, if we can have our organizers do that. And we'll have a panel discussion about the thoughts just presented. In fact, why don't I introduce them while they're walking up. You can see to my left, Mr. Huang Yiping of the Peking University National School of Development. To my very far left, Timothy Mo, who's a managing director at Goldman Sachs, where he's co-head of economics, commodities, and strategy research. And to his immediate right, we are very fortunate to have with us Mr. Qi Bin, who's Director General of the Research Center of the CSRC, China Securities Regulatory Commission. So please give a round of welcome to my panelists. So we have heard from Robert Engle that China now has significant systemic risk. The banking sector poses risks, clearly not on par with Cyprus, it must be said, or even Japan, but important risks, and the risks are rising. I think that's really what you've highlighted with your analysis, what the model shows, and a bit of the clarion call you're sounding here today. Let's turn to our panelists to get their feedback on this analysis, but also to move the conversation forward. We want to see what might be the triggers for a potential crisis, because there are multiple factors at play. Some of them are interrelated, others are not. And some of the efforts at reform that we've talked about over the course of the last day and a half may actually create further risk, or at least open up the possibility of further volatility. And so I want to explore some of these topics with our panelists. Perhaps I can start with you, Huang Yiping. Can you give us your perspective? We've heard a sharp analysis from Robert Engle about banking sector risk. Do you share that view? Is he too cautious in his arguments? Where do you come out on this?
Well, I very much would be in agreement with what Professor Engels just said. The 2 points I'd like to highlight. The first is obviously the leverage ratio went up quite significantly, just the system-wide leverage ratio. We used to have the credit GDP ratio at around 75%, and now it's 200%. That happened within a short period of 5 years. I think that made everybody worried in China, including some in the government, because if you read the book, this time is different. One thing we learned from the book is you look at the last 800 years, whenever you had a period of excessive credit growth, you end up with something painful, the adjustment. So that's why I think we needed to watch it closely, and the leverage might be inevitable.
But you go on from that, right? I mean, in addition to that historically based observation, you worry that the credit growth is diverging from the direction of GDP, where we all know China's growth rate has softened. Tell us a little bit about that concern.
Well, that's probably even more worrying, because not only the leverage ratio is rising, but you start to see divergence between the credit growth and the nominal GDP growth. Last few months, it's quite clear, and you look at the last few months, nominal GDP growth is probably running at slightly below 10%. Credit growth is at a pace of slightly above 20%. That probably means something in between didn't really support economic activity. That's why I think the worry is quite serious. But the second point, I also want to support the point Professor Engels just made. The government does have capability in the near term to recapitalize and support. So I think we're not going to have a financial crisis or banking crisis before we have a debt crisis. In addition to the foreign exchange reserves you just mentioned, the explicit public debt GDP ratio is still only around 16%. That's like probably one of the lowest numbers in the world. Now you obviously can add lots of contingent liabilities to it, but the comparable numbers with developed countries, we're probably still talking about something like between 40 and 50%. So I basically agree with the basic point that the risk is rising quite significantly, but at the moment, I think it's still manageable.
So if it were to move to crisis point, in your judgment, China has the resources to deal with this from internal resources, in contrast with, say, many countries in Europe. France was highlighted, for example. For now. But that raises the question: do you fix the roof on a sunny day when you see the clouds, or do you wait for the rain, or worse, a terrible storm to come in? And I think we're really at that moment. And this is the right moment for me to turn to our visiting regulator at the table. Let me turn to you, Yiping. Give us an idea of what is the perspective on what government is doing now. First of all, tell us, do you share the analysis that there is a crisis brewing in the banking sector? Not imminent, but nevertheless something of concern. And what might government do about it?
Well, I think there is always the possibility of a crisis, right? But,
no, that's an evergreen answer. I'm not going to let you get away with that. In China today versus 4 years ago, as the professor argued, are we more likely to be in a crisis? Is there reason for concern?
I'm not an expert on banks or banking sector, and particularly given that I'm a security regulator, it's not very much politically correct to comment on the banking sector risk. But I think China's biggest risk has always been that there's too much reliance on the banking sector in the financial system. Back 5 years ago, in 2008, China's banking asset in the financial system was 63%. Now it went up to 78%, if not more. And I think that poses the biggest risk for China. My biggest concern is that in 5 years, this ratio might be higher. I mean, I don't think that's what we want to see. And I think going forward, the best way to reduce that risk is to develop securitization products. For example, we can securitize some of the loans, and for the urbanization, we can develop some ABS as a back security, so that we can reduce the kind of potential risk from the banking sector or the municipal debt.
So expanding, liberalizing capital markets would reduce the aggregate reliance of the financial system and the economy on the banking sector. So and China's beginning to do that, as you point out, under the leadership of your organization. But in a way that ducks the question, right? Because it doesn't deal with the risks inherent that have been identified in the banking sector. I wonder if I'll let you off the hook for now, but let me turn to Timothy Mo of Goldman, where your shop has done a lot of interesting analysis of late on what might be the true level of non-performing loans, for example, in the banking sector. Can you tell us how you see, again, the question of banks, which has been first identified, and how risky you think it is?
Sure. So I'd answer that in two ways. One is what we think the level of NPLs is, and the second is what do we think the banks are pricing. And that goes back to Professor Engle's model, which and approach, which I think is tremendously useful right now to have a live gauge on this, which is what we need in dynamic markets. So I think there are sort of three salient points. First is that the current level of declared NPLs is quite low. Overall, it has been rising, but it's about 1%. Now, obviously, the market doesn't believe that. That's why the banks are trading below book value. So the question is, what do we think the real level of NPLs is? And that is conditional upon the economic environment. So we all know that there's a vicious or a virtuous spiral whereby when economic activity recedes, then cash flow pressure increases. Now, there are some concerning signs. This gets back to this all-important point of the pace of change, which is the most alarming thing. So what we're seeing, for example, is that the increase in the number of bills that are being issued to cover working capital needs has gone up dramatically, and that's one of the indicators of short-term financial stress. So it's quite clear that the stresses are rising. Now, in terms of what is actually being priced into the market right now, our calculations that the listed bank share prices are implying about 6% to 7% NPL loans today. And if we look forward over 3 years, given the returns on equity that the banks are earning, then they're probably on a 3-year forward basis implying about 15% NPLs. We think this is another example of the market showing its wisdom, because when we do some stress tests of the likely overall impact to China of a banking problem, I won't go into the details now because I know time is tight and your fingers are wrapping on the table, but we reckon that the overall number that's reasonable under a reasonably harsh case scenario is about 15 to 20% of GDP. And so the number is kind of what the banks are pricing in as far as NPLs versus the overall burden on the economy, and the bailout that may be needed, the transfer of wealth from the 3.4 trillion to some form of absorption by the state. These numbers start to harmonize. So we think the market is pricing in a reasonably harsh risk case, not the ultimate worst one you can imagine, but quite a severe risk case.
Robert Engle, what do you think about those sorts of numbers? Is that something to stay up at night with nightmares, or is that something not nice, but China could probably handle it?
Well, I do think that that China can handle this, but I think they need to handle it. And I'm encouraged by the fact that there's a lot of discussion, I think, about this. I wonder, in this market valuation of the financial institutions, whether we're really correctly evaluating these NPLs, these non-performing loans. Because normally when we do this, we have some sort of a recovery rate assumption. And I wouldn't be too surprised if the recovery rate of these non-performing loans might be 100%, because they're sort of guaranteed. And so I suspect that you haven't used 100% recovery rate in doing this. And consequently, you have used 100%?
No, we've not. Our analysis definitely had the harsh case one had much lower recovery rate.
So I suspect that if you did that, you would say that the market is pricing the number of non-performing loans at a whole lot more than what you're saying.
The real question comes down to in the banking sector, will these loans, when we talk about non-performing, I mean, they may be dud loans, right? They're not good, they weren't good investments. But as long as a rich uncle is going to back you, do investors, be they shareholders or other stakeholders, how much of a systemic risk, coming back to our question, does this really pose? Does anyone want to take a view that this is something more than a second-order problem for China? For example, if we were to see in combination with the banking sector, let me broaden out the portfolio of concerns, an external shock, right? The external environment. We've seen other kinds of, or a deeper slowdown in China itself than expected, for example. Anybody want to weigh in on, sure, if you want to pick that.
I mean, to keep it tight, systemic risk is clearly risen, I mean, for sure. And again, I think one of the most important charts that Professor Engle showed was that increase in the valuation, this risk valuation that's taken place in the last year and a half. 2 years ago when this debate, or 3 years ago when this debate first arose, we felt that at that point people were being overly negative, but we become progressively more concerned as the rate of liabilities has increased. Now, if we combine that, and this goes to Yiping's point with respect to diminishing credit multiplier, the lower efficacy of credit, then we have growing concerns, and if those are exacerbated by a slowdown in the global economy or an external shock, then we clearly are in much more risky territory. I think what this speaks toward is the need for the sort of prescriptive regulatory reform, Dr. Engle, that you were mentioning, And the sorts of things which we've heard, and I'm sure my esteemed colleagues can develop this more, would be the need for some tax and fiscal reform, the need for an appropriate risk pricing of credit, the need for supply-side administrative reforms, the need for proper pricing of resources and subsidies, the need for SOE reform, and also the need for the mechanism of lending reform. There's a whole integrated package of changes which, if they're made, I think can defray the systematic risk. If they're not, then we're on a path which becomes progressively more worrisome.
There's one risk that you didn't underline heavily, one reform, that is liberalization of the currency. Huang Yiping, this is something you've looked at. Your center looks at this question quite carefully. And when we were speaking earlier, you were telling me with some confidence that you thought that we might see basic convertibility by 2015. Can you tell us a little bit about that trajectory of reform and what implications that has for our conversation?
Well, I can't say with confidence that we're going to see convertibility by 2015. I think this is a position some more aggressive policy thinkers within the government are hoping to achieve basic convertibility within a couple of years and then full convertibility by 2020. But this issue, I can tell you, there still is a huge debate. Within China, there are quite a number of very prominent economists cautioning some officials that you want to be careful, partly because of the state-owned commercial banks, state-owned enterprises involved. But also, I think there is a big question about this market discipline. You can lend, you can create non-performing loans, but if you can, two things I think would have to come together first. The first is interest rate liberalization. If you cannot properly price capital, forget about the risks and the rational behavior. But in order to have a proper pricing of capital, you really need market discipline. And these two things, I think we have to see significant progresses before we actually will be able to see orderly liberalization of the capital account that we're talking about. So it's still uncertain, I think, but my sense is some officials within the government are more inclined now to see more aggressive liberalization in the next couple of years.
A quick point on that?
Yes, I wonder if it were well known that there would be convertibility at a certain point in the future, whether that would spur all these other transformations that you're talking about. It would spur banks to clean up their balance sheet. It would spur the interest rate regularization that we need, and it would be kind of a target that everyone could be working toward to be ready for the moment when convertibility happens.
This is actually one very strong argument within the government that we use capital account convertibility as a driving force of many of the domestic reforms. And one of the good example often was given was the WTO entry we had more than 10 years ago. That reform, actually what you end up with was a much broader domestic structure reform. For instance, the chief negotiator, Long Yongtu, once said, the hardest hit sector with that WTO entry was not agriculture, industry, or trade, but the government, because you need to carry out lots of reforms in order to get to that. So I think now people looking at the same argument, we could actually use capital account convertibility as a driving force for overcoming domestic resistance in many of the areas. The only risk is you can actually push trade liberalization relatively easily. But if you're using that to push for capital account liberalization, the risk might actually be much bigger. And that's something we're not sure.
That's right. It's, you're grabbing hold of the tail of a tiger in a way, although your WTO analogy is well taken. I'm being waved at that time is running short, but I'm going to go a little longer because we started quite late, and so this is such a fascinating panel. There was mentioned in passing interest rate liberalization just a moment ago by Huang Yiping. I want to pick up on this question because, of course, interest rates historically have been fixed, and indeed, rates for savers have been suppressed in China. But now we are seeing an explosion in recent months of wealth management products that have given some degree of flexibility in the financial system. Interest rates, banks compete on these products. Savers now have some options, but it's a lightly regulated area. There have been concerns raised about this as well, contributing to systemic risk. Let me ask Chi-Min, can you give us your perspective on WMPs and maybe more broadly, what is the regulatory perspective on this? It has been said that there needs to be more regulatory discipline in this area.
For this asset management products,
Sure, yes.
I think the need for asset management in China has been increased dramatically over the years because the wealth accumulation in the past 30 years has been the GDP grow probably 150 times, and the personal wealth in total grows probably 1,600 times. So that gives you some idea how much asset management business will be needed in China in the years going forward and in the past few years. I think, therefore, the banks took this opportunity and did a lot of such business, but not in a fully regulated way. And I think there will be a huge need for regulatory harmonization in this area. We need to have the same kind of standard. You're going to have same kind of rule for mutual funds and if banks engage in this business. But I think there's been some progress in that aspect.
Are we likely to see more significant reforms in this area, more significant regulations?
Oh, yeah, absolutely. I think
Absolutely,
so,
and in the near term.
yeah. And that partially created the shadow banking problem in China,
Right.
as you know.
And one other area that we haven't touched on that I want to talk about, because many people outside of China particularly ask this question, what about the property bubble? And could that be a trigger for some sort of systemic crisis? What do you think, Robert Engle? How concerned are you about property here in China?
Well, we would expect the most expensive property in China to be in Shanghai and Beijing, and it is. But the question is this a bubble? And I'm not sure what the answer to that is, because it may or may not be. But if it's a bubble and it collapses, how dangerous is that to the economy? We have learned in quite a few countries and different circumstances in the last 20, 30 years that property value declines are very damaging to the real economy, that the financial institutions are very vulnerable to falling property values, and these trigger really the financial crisis that we've just been through. And if China does have a property bubble that's going to collapse, this is going to, I think, again, very heavily impact the financial sector, and consequently will require massive amounts of public money to restore the strength of the banking sector. And this is going to happen in exactly the time when the public sector doesn't have such great reserves, because property values are going to go down if the economy slows down. So it's going to be exactly when there is no money to do this. So I think if the property bubble is a bubble, and if it collapses, it's going to be very damaging for the Chinese economy.
All right, so a strong note of caution. Timothy Mo, let me ask you, are you as deeply concerned, or do you take a more relaxed view?
I think we take a more nuanced view. The ultimate conclusion, we totally agree with, that if you had property prices going down a lot, that would be a clear negative effect, given the financial vulnerabilities that we've been discussing. And there's all sorts of examples. I mean, Spain's a great example in Europe of what happens. The only sort of nuance that we would point out to, the difference, is that for the core residential market, in terms of the sort of problems or stresses that, for example, caused significant issues in the United States, we think that the situation is different in China. For example, in the US, you had just a plethora of purchasers of homes who couldn't afford them and were given credit inappropriately. And that was where the stress resulted. So when people couldn't pay back, you had the debt collapse. And you had
We had liar loans and
liar loans, non-doc,
100%
ninja,
plus
and then you
mortgages,
had
that sort
jingle
of thing.
mail, people handing their stuff back
Right.
in. And just the point to make is that China is very different. The
whereas
actual-
mortgages are much less common in China for lots of reasons.
Absolutely. I mean, the leverage, the actual end user, there is a much stronger demand dynamic for property in terms of the growth of the population, urbanization, the need to replace the housing stock. There's a cultural affinity toward owning property. There's collective deployment of capital to buy property. The male-female ratio, which has become distorted, means that if you want to find a wife, you better have a house to house her in. And so there's a very strong cultural dynamic towards owning and keeping property. So the point is that at the core ownership of residential property level, that is actually pretty sound. And in fact, if you look, the government has preemptively tried to suppress things, and so whenever those measures have been released, you see a lot of demand surging back. So the problem, we think, is not in the core residential property area, it's in the surrounding ancillary ones, which may add up to the same thing, by the way, but it's in whether it's the developers who've leveraged more or the wealth management product creators who've used property as collateral. That is the layer that we're much more concerned about. And if that starts to come under stress, and then maybe have to call some of those collaterals in, then you can get that cascade effect. I just want to be clear about where the source of the greater risk is located and the difference between that and the United States.
Right. Very good. We're coming right near the end of our time, even with me going beyond the allocated time. I thought just in the interest of getting a quick feedback from the audience, we're going to do something that's not on the script. I'm going to ask for a poll from the audience. How many of you, and this is a forced poll, unscientific, don't quote me on this, but you must...
Big data.
Exactly. This is like really tiny data. You must vote yes or no. There are no mugwumps sitting on the fence with your mug on one side and your wump on the other. And the question is this. Do you believe that China is headed for a banking crisis? Yes or no? And of course, yes, you do think this is going to happen. No, you think whatever you've heard, it'll be managed, it'll be solved, it will not be a crisis of the sort that we're discussing involving systemic risk. So again, a forced vote, even if you're not quite sure, lean one way or the other. Hands up, how many of you do think, yes, China's headed for a banking crisis? Hands up. Okay, now, how many of you think there's not a crisis coming? All right, well, there you have it, folks. Overwhelmingly, the stern intellectual forum has decided that all is well here in China.
No, it means what they decided was it can be solved.
Right. No, but actually, what they that's not what I asked. What they've decided was that because people will refer to his website on a regular basis, regulators will take prudent action based on those warnings to avert any possible crisis. Please join me in giving a round of applause to our expert panelists. Thank you very much.